Good evening and welcome to the webinar this evening. So it's going to bring the screen up here. Okay, so we've split the screen so you can sort of get a view of myself and the slides. So I understand you should be able to adjust that on your browser or your device just to make one larger or smaller if you can't see. So topic tonight is to position yourself for Auckland's next growth phase. Just to start off with the standard disclaimer for these things. So this webinar is general information only. It doesn't take into account your own personal circumstances. It's not personalised financial advice. And please, before acting on anything that you hear this evening, do seek independent professional advice before making decisions. Okay, so a bit about me for those of you who don't know. My name is Darren Brown. Born and bred in Auckland and have been a property investor and developer for, investor anyway, for the last 30 or so years. Married with 3 gorgeous daughters and all schooling in Auckland here in central Auckland. So I started off in my investing journey about the age of 20, 21 when I bought my first property and have kind of been addicted to property investment ever since. About 15, 16, 17 years ago, I got involved in property development, and we did the sugar tree development in the CBD. So the first building we completed in about 2015. It was 148 apartments as part of the Sugar Tree Prima development. The second one we did was Sugar Tree Centro, which was 269 apartments, and that completed in 2017. And the third one we did at Sugar Tree Ultra, which was 306 apartments, and that was completed in 2019, just before COVID hit. We took a break for a couple of years, and then we are now currently doing the Chelsea Rise apartment development in Birkenhead, which is a premium product, so quite different to the Sugar Tree that we did previously. And we're about 12 months into construction on that Chelsea Rise project. So what we're covering today, a few topics. So it's about a 30-minute webinar. We'll try to go through it relatively quickly, and there's a chance of questions at the end if you'd like to just put any questions as you go through. We'll just try to answer any at the end if we get time. So really want to talk about why property is still the best investment class for most people. There's been quite a lot of commentary in the media recently that property won't be the same investment that it has been in the past. So what I'd like to do today is sort of explain why we think that is wrong and why we think property will continue to be the best investment class for most people, as it has been for myself over the last 30 or so years. So we'd like to talk about the current market conditions for property, where we are now, where we've come from over the last few years, and where we're likely to go over the next sort of little while. We're going to focus particularly on Auckland this evening. And the key question I'd like to answer tonight is Auckland about to enter a growth phase? I'm going to compare new property versus existing, which is better. I'm a developer, I'm going to have a slight bias one way or the other. And also I'm an apartment developer. So when we're talking about apartments versus townhouses, again, I'm going to be slightly biased, but I'm going to give you my genuine view on the matter. Advantages and pitfalls of buying a property off the plan. And at the end, I'll just do a quick plug of Chelsea Rise, our latest development. And again, at the end, we'll just run through some questions if we have time. So I'll just start really quickly on different asset classes. Many of you will have seen this before, so I won't spend too much time on it. But, starting at cash assets, which is savings account, term deposits, typically low risk, low return, high liquidity. You've got your fixed interest in bonds, which is basically where you're lending money to the government or businesses. Those are slightly higher rates than you get for cash in a savings bank. Again, quite low risk, but also quite low return. And also you're paying tax on both your cash and your fixed interest bonds at your standard rate. You've got property, real estate. That includes Auckland residential, commercial, and just obviously commercial residential in general. We only focused on residential this evening. Again, higher risk, higher return. And then we've got shares and equities. Again, higher risk, higher return. And these days also we talk about alternate investments such as gold and silver, which have been around for a long time, and then the newer assets such as Bitcoin, cryptocurrency, and the like. We're not going to talk about those this evening. They're very, very high risk, highly volatile, but certainly some people have done well out of them. So let's continue. Just really brief summary to start with on asset class returns over time. This has been done over the last 30 years. Approximate numbers, so cash typically over the last 30 years has been about 5%. Again, you're paying tax on that. Fixed interest and bonds, 6%, again paying tax on that. Shares and equities, typically about 8%. That includes dividend income as well. So typically the way these things work is that you're generally not paying tax on your share capital return, but you're paying tax on the dividends. And again, same with property. It's typically been a bit higher than shares and equity over the last 30 years in New Zealand. Again, generally not paying tax on the capital growth, but you are paying tax typically on the rental income. And that's just a graph showing the different returns on the different asset classes. Now, just to be clear, this doesn't include any borrowings or anything like that. This is just straight. If you put $1 million into cash, that's the return. Well, this was based on $1,000, and property, same $1,000 at the start, and that's what it gets to at the end. So the reason why I am so strong on property and just truly believe in it is the number one word is leverage, and typically you cannot get leverage with the other asset classes, or very hard to do anyway. So with property, you can generally borrow up to about 80% of the value of the property when you're buying it. What that does is it allows you to increase your return on investment. So in the previous slide, we saw that property was typically, over the last 30 years, returning about 9% when counting the capital gain and the rental income. When you use leverage, you can increase that figure quite significantly. It can also minimize your tax liability as well. Again, capital gains generally aren't taxed, whereas rental income is. So a good tax property accountant can assist you with how to structure your affairs in the correct way. When you're using leverage, it does increase your short-term risk. So you typically need a longer-term time horizon when you're employing that strategy. I would personally say a minimum of 10 years. When I buy investment property, I generally look at a 20 to 30-year time horizon when I buy. So the next slide, I'm going to give you, I was trying to work out how I could best really demonstrate what we're talking about in terms of how leverage really works in practice. So what I did is I had a look at the oldest properties in my portfolio, and I picked properties 1, 2, 3, and 4. So they're the 4 properties I've held the longest. And I just thought I'd run these real life examples for you. So the first one, 2003, sorry. I did purchase a couple prior to this, but I had sold them, rebalanced the portfolio a while ago, but these are the ones that I've got left. So 115,000 for property 1, 20% deposit, and current value of 570,000. So total return of 455,000 over that period of time. That works out to a compound annual return of 14.5%. Property 2, very similar, 118,000, similar deposit, 610,000 now, total return of 492,000, which is 14.8% compound annual return. Property 3, 260,000, current value 1.2 million, return 940,000, and again just over 14% return. And then again for property 4, you can see something quite similar. So what I really want to impress upon you is this is why leverage works when we're talking about property investment. You typically can achieve these sort of returns if you structure your property buying in the correct way. and you plan to hold on for it for a long time. I must say as well, with these examples, the returns were actually better. Number one, these are tax-free, so there's no tax payable on those sort of returns, except for tax are paid on rental income along the way. But back in these days, you could actually buy property for 10% deposit. So the returns for these properties are actually a bit better than they show here. This is the National House Price Index based on REINZ figures over the past 30 years. And it's really important when we're buying and investing in property that we understand how property cycles work. And what we can see here is that there are a number of different property cycles that have occurred over this period of time. So we start back in 1995, and we can see between about 1995 and the year 2000, the property prices didn't really go anywhere. They were quite flat for about that 5-year period. What happened over the next 6 or 7 years is that they slowly inclined, went from the year 2000 to about 2007. And so they kept going up through that period of time, and there were some really good returns to be had in that period. Then we had the global financial crisis around 2008, and between then and about 2013, property prices actually went down a little bit to start with and then just stayed flat for that 5-year period. So we had 5 years where really property prices didn't go anywhere at all. And then what happened in about 2013, 2014 is that the property market started kicking off again. And we had a really strong period of growth from about 2013 through to about 2016 or so, which leveled off then about 2016. And you can see when we get to about 2016, 2017, there's another flat period until about 2020, where we had that big COVID spike that just really came out of the blue, and it was quite unprecedented in terms of a big spike. And what we've had since then is that the property prices have taken a sharp turn down, and then they've kind of just cruised along the bottom for the last 3 years or so. So how far have prices fallen since the peak in 2022? Well, it depends on where you live, and it depends on the market we're talking about. So Wellington is down nearly 27% based on the latest figures. And Wellington is kind of an interesting case. It is quite exposed to the public service sector, the government employees and what have you. So that's taken a hit as a result of that. Auckland is down 23%. Waikato is down about 12%. So they've started coming back. Canterbury, interestingly enough, are almost back at the peak of the market. And Otago, Queenstown area are actually in positive territory after the peak of the market back in 2022. So they've done really well. And people, when we talk about these sort of figures, they go, oh, well, clearly we'd be buying now in Canterbury and Otago. And I'm saying, well, hang on. They've already had their boost. They've already gone up in value. They're back to where they were at the peak of COVID. I see, when I'm looking to buy property in this market, I'm looking, okay, what hasn't been doing well? Where is undervalued right now? And that's what kind of drove this whole discussion around Auckland and what happens next. And if we have a look at Auckland in particular, Auckland was the hardest place in New Zealand hit by COVID due to lockdown. So we were locked down for longer than anybody else. And it'd be fair to say we were most affected by that. Property prices have reduced 23%, as we said. There are a lot of studies showing where Auckland sits in comparison to historic averages, the averages of other properties in New Zealand. And right now, Auckland is sitting 9.3% below the average. What that means is that Auckland needs to catch up by 9.3% before it even starts looking at any increases. So there's a huge potential benefit to gain just from Auckland reverting back to where it sits normally. Auckland has also been hard hit by low immigration figures. So at one point, end of 2023, or mid-2023, so we were about 135,000 net immigration. That dropped to 14,000 in 2024, and 25, about similar level. So Auckland has been really affected by the high interest rates as well that we saw when interest rates got up to 6, 7, 8%, because typically in Auckland mortgages were higher than they were around the rest of the country, so they got more impact out of higher interest rates. So Auckland was also affected by reduced international students, lower tourism numbers. The service and construction sectors were hit pretty hard. And also Auckland didn't benefit from the primary and dairy booms that we have seen over the last few years, and other places around the country have certainly benefited from those. Interesting immigration figures. So this shows you that 135,000 in 2023 that we talked about. 2024 went up to 23,000, 2025, 14,000. Just starting to edge back up again though. So 23,000 in the year ended January 2026. And the next slide in particular is one that really caught my eye the other day. In January, new figures were released, and they showed a net immigration in January of 4,800. Now, bear in mind, these figures can get adjusted from time to time. But if you do take that 4,800 and extrapolate that out to a 12-month figure, you get close to 60,000 migration or immigration migrants back in the country. Now, if we get back to that over the next 12 months, that's going to be a huge positive for the property industry and the property markets. The short answer is I expect Auckland to rebound, and I expect it to rebound quite hard when it does. Auckland is New Zealand's only truly international city. Around 50% of new migrants settle in Auckland. And even though we had migration numbers reducing, Auckland was still growing at about 1% per annum. We're over 1.8 million people now. Auckland stands to benefit probably the most out of any part of the country from the increased migration figures that we just talked about. Also, the low interest rates haven't come down from big numbers. They take up to 24 months to flow through to the property market, and Auckland is still to benefit from some of that. Typically, Auckland has led the country in capital growth, 7.1% versus 6.6% for the rest of the country. So I certainly expect Auckland to revert back to the norm once we wash through this next period. Interestingly too, there's a new city rail link opening in Auckland next year, later on this year, and there's a new convention centre open, and that will drive a huge amount of tourism and Airbnb demand as well in the central city and the surrounding suburbs. So these are real positive impacts for Auckland. I'll get just finished on Auckland a little bit later, but first of all, just looking at new versus existing property and looking at the different options that investors have available. I, through my time, bought a mixture of new and existing properties for my property investment portfolios. The benefits, and you could argue that there are benefits to both sides. The benefits for new is that lower deposit, 20% versus 30% for existing property. That's for investors. Debt to income ratios, new property is exempt from debt to income ratios. Now, in July 2024, a new standard came in as to what investors could borrow. It's tied to the amount of income, and it's 7 times income for investors, 6 times income for owner-occupiers. And that sounds okay until you buy a first, a second, or a third investment property, and then it starts getting really hard. So if you want to build up a portfolio of properties, which I would encourage people to do, you really need to start looking at new properties. Don't just listen to your bank when they say, sorry, you can't get any lending because you've exceeded the debt to income ratio. Have a talk to your mortgage broker, have a chat to us. We can tell you certainly the ways around there to buy new property, and certainly there are brokers out there that will be able to give you advice if your existing bank isn't prepared to do the lending for you. Other advantages of new property, you've got low maintenance costs, generally for about the first 10 years of a new build, as long as it's been done to a high standard. You'll get very few, if any, maintenance costs. Whereas existing properties, and I know I've bought many existing properties in the past, generally within the first couple of years, you're looking at anywhere from 10 to 50 grand deferred maintenance costs, where you're fixing up stuff that the previous owner just really neglected or didn't take care of. And people, when they buy existing property, they really don't factor that in. New properties, obviously built to new building code standards. It's Healthy Homes compliant, and it's certainly a lot easier to tenant and a better quality of tenant typically as well. Buying off the plan. So when we talk about buying off plan, what we're talking about is buying property that isn't built yet. So that can either be before it started construction or during that construction period. People will buy off the plan for a number of reasons, but one of the biggest ones is that you get to buy at today's prices and you don't have to settle for till tomorrow's prices. So if you're thinking that property prices are going to go up or likely to go up, then buying off the plan in today's market can be a really good way of getting a gain or benefit from doing that. Also, you get first choice in a development. You get to pick the ones that you want, and generally it's a 10% deposit to get in, which is held in a lawyer's trust account until completion, so the developer doesn't get it. If you've got an existing home, a good mortgage broker can show you typically how to leverage the equity in your existing home to put a deposit down on the new property without actually any cash needing to be paid on your part. There's potential tax-free capital gains as well. And also, you're not having to settle straight away. You can buy a property, put your 10% deposit down, and then you might not have to settle for 12 months or so, which gives you a bit more time. There are risks in buying off the plan, which we always like to talk to people about. Sunset clauses, all off the plan contracts have them. Just make sure that your sunset clauses in a off the plan purchase doesn't allow the developer to cancel that contract to sell it to somebody else at a higher price. And there's been plenty of stories of developers doing that. So just make sure they can't do that. Sometimes substitution product clauses are quite vague. Just make sure that any substitutions, which can happen from time to time, make sure that they are equal or better standard. Make sure that the deposits are held in a trust account by a lawyer, and make sure the developer can't access them. That's the most important. And also make sure you're dealing with a developer that's experienced and understands the market. There are plenty of stories with inexperienced developers that have really got projects wrong, and the people that end up paying that or wearing the costs of the purchases. So just make sure you're dealing with people that understand what they're doing and know what they're doing and have a proven track record. Townhouses versus apartments. We've seen a massive boom in townhouses over the past about 9 years or so, and it dates back to some planning changes in the by Auckland Council back around 2016, 2017. So there's a huge number of townhouses that were built, and they're still being built. And I had a look at consent numbers for the last quarter for Auckland City or Auckland Council. Only 5% of the building consents issued in the last quarter of last year were for apartments versus 62% for townhouses. And that's massive. There's a huge surplus of townhouses on the market now, which are going to keep their prices low even through the next cycle, in my opinion. I just think there's too much surplus stock on the market of townhouses, and I think there's a limited market for people that want to live in or buy townhouses. Townhouses do appeal more to younger families. That's your target market, potentially singles. Whereas apartments are more suited to immigrants and particularly downsizers. There's the single level living that is really important, along with security and things like that. So both product types have a market. The problem is townhouses there's so many being built that they've just exceeded the market for them. Whereas apartments in this latest cycle, there've been virtually none or not many built anyway. There's hardly any under construction right now. So when the market does take off, there's going to be a shortage of apartments. And typically, the other point on apartments versus townhouses is that there's generally with apartments you can use Airbnb option as well, which helps you to generate better returns in certain markets. And this is just some of the positives of apartments. Again, I'm an apartment developer. I do have some bias here, but this is what we hear from our buyers and other people in the market. You can generally get a better location for apartment developments because you're sharing the cost out over a larger number of people. You can build close to amenities. You can build in villages with all your shops around you, cafes and restaurants and everything. You get more views as the building goes up, higher levels of security and single level living. And you get shared facilities such as residence lounges and gyms, as we've got in Chelsea Rise. So we've got a large residence lounge that doubles as a co-working space and a social club, social area for residents in the evenings. Body corporates make it really easy to maintain your apartment developments. So a lot of people get scared at the words body corporate, but all it simply means is that if you own a house, you pay insurance, you pay maintenance, you pay all your costs involved in keeping that house running. And with a body corporate, those costs are simply paid for by the body corporate itself and then divvied up amongst the owners according to the value of the property that they have within that body corporate. So it's just as simple as that. Most of the cost of a body corporate, or a lot of it anyway these days, is an insurance for the building, which again everyone pays. And Airbnb is becoming really popular as tourism numbers come back and increase, along with that convention centre opening up. We've already seen much stronger demand for Airbnb now, and that will flow through to properties that are well catered to that Airbnb option. And here's my 60-second plug on Chelsea Rise. So this is the building that we're building right now. That's obviously AI render. AI render, I think it is. Shows you the location of the building, what it's going to look like when it's finished. Shows you the position looking back towards the city, the bridge out to Devonport and out to Rangitoto. It's stunning views. We've got that residence lounge I was talking about. You've got literally everything at your doorstep. It's in the heart of the historic Birkenhead village, which is just getting better and better with each week. Each week it seems like it's a new high-end business that opens up in the village. So it's just a great spot to be. It's 8 minutes to the CBD and great public transport options. You're 5 minutes down to the ferry, which makes for a really nice commute into the city in the mornings and views. And we were sitting up in the city last week, actually, looking around the shore from the city at a high level. And I can tell you, it's the only crane on the North Shore right now that we could see anyway. And what that means is that there's going to be a real shortage of property in the North Shore over the next few years, because projects like this take a long time to get up and running. They don't just happen overnight. So finally on Auckland, here's my summary on Auckland. We're currently 23% below the peak in 2022, and it's been flat for the last 3 years. Properties are basically on sale. It's about 9% cheaper than other New Zealand properties based on historical average and historical data. Interest rates are much lower now than they were. They were 7 or 8%. They're now down to 4 or 5%. Immigration is set to increase, and we could already start seeing it come through the numbers. And building consent numbers are still really low, except for townhouses, which are not a preferred asset class right now. So within the next 5 years, we're going to see a really strong boom in the Auckland housing market. In my view, it will start happening in the next 12 to 18 months. So that's my take on the market. If there's any questions, I'll have a quick look on the screen. And if you have any interest in Chelsea Rise, would like to know a little bit more, feel free to jump on our website, have a look, or contact myself or Trevor or any of the team. Okay, all right, and we've got got one question here. So just interested in the Iran, the situation in Iran, and what your take on how it will affect the property market. So the Iran situation, I mean, it's one of those things that comes along once in a while that affects the market. We don't foresee. It's certainly going to have a short-term impact, and is having a short-term impact on gas prices, will flow through to food prices, material prices, and what have you. But it's also likely to act as a handbrake on activity for a little while it happens. So the Reserve Bank, if they were to put the interest rates up, it's not going to change the flow of oil through Iran. So the Reserve Bank can do very little about it, and I saw them speaking today, and I don't think they're going to. So my take is that initially short-term prices will go up, then they'll come down once the situation resolves itself, hopefully not too long. And I personally think, and I've seen this echoed by a couple of bank economists as well, that if the situation were to continue happening in Iran, then we'd see probably interest rates go down rather than up. So yeah, that would be my take on it. So yeah, short-term impact. Also the other impact as well is that you're more likely to have people regarding New Zealand as a safe haven. So I would expect to see less people leaving New Zealand in the short term. I'd expect to see more Kiwis returning home in the short term. And I'd expect to see more foreigners looking to come and make New Zealand their home over the over the next period, certainly in the foreseeable future, next year or so. Anyway, so that's it. Thanks so much for attending this evening. Appreciate your time. Hopefully we've been able to give you some value. And we'll, as I said, if anyone has an interest in Just Your Eyes, please do get in contact with us, and we're happy to sort of chat to you some further. We've got a nice showroom in Birkenhead on the main street, and come in and just have a chat and go through some options with you. Thanks all. Bye.